Hello everyone, this is ACC Amit Kumar and I am here to discuss with you the intra-group transactions which happen in preparation of consolidated financial statements we need to eliminate. So when we prepare consolidated financial statements, there are dealings which happen between parent and subsidiary, parent selling goods to subsidiary or subsidiary selling goods to parent. Now how to deal with these intra-group transactions? So there is a principle which we discussed in our previous session as well, that intra-group transaction in first instance are eliminated with the elimination of investment in subsidiary. Now there is a parent which has invested in a subsidiary. Now on consolidation we are adding up the results of parent plus subsidiary. So the first intra-group elimination which happens is on the date of acquisition. In parent's books it is investment in subsidiary. This investment in subsidiary on the other side gets eliminated with the share capital of subsidiary, retained earnings on date of acquisition, even share premium or other components of equity like revaluation surplus if we acquire on the date of acquisition, retained earnings on date of acquisition. These are acquired by parent in the subsidiary. So in normal circumstances in P plus S, we add up all other assets, but we do not include in P plus S investment in subsidiary. This gets disappeared and this is replaced with goodwill. Goodwill replaces this investment in subsidiary. Any amount being paid over and above the net assets of subsidiary is recognized as goodwill. So the principle behind it is asset of one entity and liability of another gets cancelled on consolidation. Now it's because of this reason that many of the learners of IFRS are confused that when it comes to P plus S, when you're presenting the consolidated result P plus S, we only present goodwill in that, like normal property, plant and equipment or intangible assets. We add up of P plus S consolidated financial statements. In consolidated financial statements, we add up the results of parent plus subsidiary. But when we add up the results of parent plus subsidiary, we remove the investment in subsidiary, and if we paid over and above the fair value of net assets, we remove this line. So this line is not presented as part of P plus S. Investment in subsidiary is not presented. This gets eliminated. This gets cancelled with the share capital of subsidiary. This gets cancelled with the share capital of subsidiary and retained earnings on the date of acquisition. Whatever we have acquired, these gets cancelled. So is the reason after acquisition in the equity and liability side, we are only left with share capital of parent only. Share capital of parent only. And even in the group retained earnings, it is parent's earnings plus post acquisition retained earnings. Post acquisition means after the date of acquisition, because whatever was existing on the date of acquisition, it was acquired by the entity. when we made this investment in this subsidiary, whatever was existing on the date of acquisition, it was acquired by the subsidiary, and this investment in subsidiary gets cancelled with the share capital on the date of acquisition. And whatever amount is being paid over and above the net assets is recognized in the form of goodwill. And in future, we only include in group retained earnings. Now this, according to our workings, if you remember, we discussed about workings. Working note number 5 was this, group retained earnings. Working note number 3 was goodwill. In our group retained earnings, we only included parents' earnings plus only post-acquisition retained earnings, which also we got to know from working note number 2. If I take you back a little bit, what got cancelled with what? Investment in subsidiary is the amount invested in the entity to acquire the subsidiary. This gets compared with the share capital of subsidiary. Is the reason on consolidation we only include share capital of parent only, because the share capital of subsidiary gets cancelled with this investment in subsidiary. And even the retained earnings which were existing on the date of acquisition gets cancelled. So if there is any share premium, revaluation surplus, any such item which was existing on the date of balance sheet, it gets cancelled with investment in subsidiary. Only post acquisition profits are included. Only post acquisition profits are included. I can show you this. So when we were acquiring this subsidiary, so this purchase consideration was the investment in subsidiary. This is the amount of purchase consideration was the investment in subsidiary. This 6,26,000 is the fair value of net assets. Fair value of net assets means it is representing, the fair value of net assets is representing working note number 2. That is actually net assets. The net assets position this is the net assets of subsidiary on the date of acquisition. So whatever is the net assets position on the date of acquisition, this gets acquired by the parent. We are paying for it, and the amount being paid over and above this is recognized as goodwill. The amount being paid over and above the net assets of subsidiary is recognized as goodwill. Now between this date and the date of balance sheet, there is a post acquisition profit which is earned by the parent. So parent has right only in the post acquisition profits. Is the reason we need to know two values. We need net assets of subsidiary on the date of acquisition, as well as we need net assets of subsidiary on the date of balance sheet. Between these two dates, there is an earning which have happened after we acquired this entity. So after we have acquired this entity, we have a right in the net assets of this entity. So can we include the share of post acquisition profits as part of our group retained earnings? So what we do, whatever is the profit earned post acquisition is added as part of our group retained earnings in working note number 5 as share of profit of subsidiary. So when we are adding this post acquisition profit, this becomes working note number 5 group retained earnings, and this forms part of the balance sheet. This forms part of the balance sheet, but the balance, now when we compare it in working note number 3, when we compare it, we paid this much to acquire, and the net assets on that particular day was, we paid 2,37,000, and net assets on that particular day was 2,12,200. So if any difference is positive goodwill, if there is negative goodwill, in case of Ind AS it forms part of capital reserve, but if there is positive goodwill, it forms part of the balance sheet. So when we consolidate them, this is the first entry which gets eliminated on consolidation. The investment in subsidiary gets cancelled with share capital of subsidiary and retained earnings on date of acquisition, and the principle behind it is asset of one entity and liability of another gets cancelled on consolidation. Apart from them, there are intra-group sale of goods. In intra-group sale of goods, parent sells to subsidiary or subsidiary sells to parent. They are also known as downstream downstream transactions, upstream transactions. Now when they sell to each other, they may become rich within their home. This is like two brothers living in the same home or same house, and to the outside world they are a joint family, but internally they manage their accounts well. The one of the brother bought a good for 50,000. Mark and Steve both are living in the same house, but for the outside world they are both together, they are a group. So when Mark sold to Steve, Mark recorded a revenue of 1,50,000, and cost of the goods sold was only 90,000. It is only 90,000. Steve purchased them. Steve has included them as part of the cost of goods sold. Cost of goods sold. Cost of goods sold is made up of opening stock plus purchases and purchased goods worth 1,50,000 less closing stock. In closing stock we get to know that half of the goods remain in inventory. Half of the goods remain in inventory. So out of the goods purchased of 1,50,000, 75,000 are still with the entity. So suppose opening stock was 0. So cost of goods sold turned out to be 75,000, and Steve has sold to outside parties sold it for 175,000 to outside parties. Or say sold it for 125,000. So when we consolidate the results, what is the impact of it? We are required to add parent plus subsidiary. Instead of Mark and Steve, I can write parent plus subsidiary so that you understand it easier. P plus S, parent plus subsidiary. How much revenue we are going to recognize? We are going to recognize the total revenue in the group financial statements of 1,50,000 plus 125,000. 2,75,000 is the revenue of the group. If we look at the cost of sales, it is 90,000 plus 75,000. Total gross profit of the firm is equal to 275 minus 165, 110. So what is wrong with this? There are two things which we need to do. One is eliminate intra-group transactions in full, and second, treatment of unrealized profit. How much is intra-group transaction in this case? The intra-group transaction in this case is 150,000, which was sold by the parent and which was purchased by this subsidiary. This is actually intra-group transaction. This is actually intra-group transaction. And out of this transaction, 75,000 of goods are still with the inventory. 75,000 worth of goods are still remaining. If in my example, if they would have sold the entire stock, say zero, no closing stock, purchase is 1,50,000 and the cost of goods sold is 1,50,000. They sold it for 225,000. If that was the scenario, even in this there is an intra-group transaction. So the reality is that the goods worth 90,000, are actually being sold for 225,000. This is actually the transaction of the group. In reality, the transaction of the group is that goods worth 90,000 are being sold for 2,25,000. That means in the middle, this 1,50,000 of revenue and these purchases is inflating the group's revenue and profitability. So how to set this right? How to set this right? What shall we do? We need to eliminate intra-group transactions in full. How do we do that? Since one party's revenue, one party's purchase, both the sides revenue and cost of goods sold are inflated by how much amount? They're inflated by an amount of 1,50,000. So shall I remove 1,50,000 from both sides, and will I be successful in eliminating intra-group transaction in full? If I say less 1,50,000, will I be successful in eliminating intra-group transaction in full? What do you say? Because this is the amount which is inflated. In reality, the net impact is 90,000 worth of goods were sold for 225. So 375 minus is equal to 225, and 2,40,000 minus 1,50,000. So reality was 2,25,000 worth of goods were sold for, actually 90,000 worth of goods were actually sold for 225. So gross profit is same. Gross profit is same, but there was one thing which was inflated. The revenue was inflated by 1,50,000. The cost of goods sale were inflated by 1,50,000. So by eliminating intra-group transaction, the one party's revenue and one party's cost of goods sold were resulting in inflating the revenue and total cost of goods sold. So by eliminating intra-group transactions in full, we have been successful in bringing it back to normal, group as a single economic entity. We have been successful in presenting the group financial statements as a single economic entity financial statements. As a single economic entity, 90,000 worth of goods were actually sold for 2,25,000. That's the single economic entity concept. Is the reason we eliminate intra-group transactions in full. In this case, there was no unrealized profit because whatever goods this entity purchased, they were successful in selling it to third parties outside the group. So there was no unrealized profit in this example. They were successful in selling the entire amount of goods purchased from the parent to third parties. So there was no unrealized profit. In this example, there is one unrealized profit. In this example, there is unrealized profit because half of the goods remain in inventory. If half of the goods remain in inventory, how much is unrealized profit in it? How much is unrealized profit? How much is unrealized profit? What do you think? If 90,000 worth of goods are sold for 1,50,000, how much was the profit being earned? It was 60,000. If half of the goods remain in inventory, that is 75,000 worth of goods remain in inventory, how much is the unrealized profit in it? Unrealized profit in it is unrealized profit in it is 30,000. 30,000 is unrealized profit, not yet realized, because half of the profit is realized. We have been successful in selling it. In my previous example, we were able to sell the entire stuff outside to third parties, so we realized the profit. Is the reason group realized the profit from 90,000 to 225. There was no unrealized profit. But in this case, there is an unrealized profit of 30,000. How do we deal with it? How do we deal with treatment of unrealized profit? Unrealized profit in the income statement. How do we deal with it? There are two choices. To eliminate unrealized profit. The two choices are actually mathematical choices, not accounting choices. Maths, simple mathematics, that either reduce unrealized profit from gross profit, or not both, or increase the cost of sales by unrealized profit amount. Increase the cost of sales by unrealized profit amount. So if you have to treat this, the first thing is we have to eliminate intragroup transaction. This we have to eliminate. This is the first thing to be done. Thereafter, once we have the profit after treating this, cost of goods sold is equal to 165 minus 150. There's one choice. One choice is to include unrealized profit as part of it. Include unrealized profit as part of it, which is 30,000. So the gross profit automatically gets adjusted equals to 125 minus 15 minus 30, because the total cost of sales is now 45,000. It turns out to be 80. So if you noticed, this was the treatment before any adjustment. This was before any adjustment. The intragroup transaction was this 150, 150. The intragroup transaction revenue and cost of sales we have already treated. The second thing to be treated was unrealized profit. 30,000. This is one way of doing it. The second option is instead of adding it to the cost of sales, we reduce it from the total gross profit. So the impact is $275 minus 150, 165 minus 150 this is actually treated. These figures are treated. These are the two treatments for intergroup transactions. This is alternative way of doing it. This is intragroup transaction eliminated. We need to anyway eliminate it. Intragroup transaction eliminated. 275,000 minus 150, 165,000 minus 150. The total impact 125 minus 15, that is 110,000, and unrealized profit is reduced by 30. So the gross profit after adjustment is revised gross profit is equal to 110 minus 30. So whichever method we use, it doesn't matter. Whichever method we use, we have to use only one of them. Either reduce it directly from the gross profit, or either increase the cost of sales. So in one example, we increased the cost of sales, Here we reduced directly from gross profit. In the second case, we reduce directly from gross profit. It's or, not both. This is one thing we need to be careful of. It is or. Either reduce it directly from the gross profit or either increase the cost of sales. The net impact on the treatment will be same. So when we are dealing with intra-group transactions as far as income statement is concerned, these are the two adjustments we are required to adjust. One is eliminate intra-group transaction in full, and one is, these are the two adjustments. So when we eliminate unrealized profit, doesn't mean that intra-group transactions also automatically get eliminated. These are two different treatments. We need to do both. One is for treating unrealized profit, one is for eliminating intra-group. Because intra-group is inflating the revenue and cost of sales, is the reason we need to eliminate that. On top of this, we need to eliminate unrealized profit as well. As far as balance sheet is concerned, so as I said, depending on whether it is upstream or downstream, this was how we'll deal with income statement accounting in the balance sheet. For intra-group transactions. Accounting in the balance sheet for intergroup transactions, if parent sells to subsidiary or subsidiary sells to parent, we have two workings which are used to deal with it. Those two workings are, one is this working note number 2, one is working note number 2, that is fair value of net assets of subsidiary. The total working note number 2, and second is in working note number 5, group retained earnings. These are the two areas where we need to make these adjustments in working note number 2 and working note number 5. In working note number 2, if subsidiary sells to parent, if subsidiary sells to parent, the adjustment will be in the books of subsidiary, which is actually working note number 2. So we make the adjustment directly here. If there is any unrealized profit, say 9,000, that unrealized profit is directly deducted from these earnings on the date of balance sheet, minus 9,000, and we are successful in dealing with it. In the absence of this, the calculations would have been simple directly, and if there is any unrealized profit, we need to include that unrealized profit as well from our earnings. Our earnings reduced by that amount. If you noticed here, the moment unrealized profit is removed, the earnings are 712. The moment the earnings are included, they are 705. So earnings reduces with the removal of unrealized profit from the earnings of the entity which sold those goods. So the entity which sold those goods was subsidiary. So now the impact of this is that this 9,000 unrealized profit is automatically before this adjustment and after this adjustment. If you have a look at the impact of it, if it was post acquisition profit, the post acquisition profit, the impact of this on the earning in the absence of 9,000, the earnings were actually 712 minus 626,000, 86,000, and if parent has a share of 80% in it, it is 6,000 and 20%. This is the value of NCI. But the moment we include 9,000 into it, minus 9,000, have a look at the impact. The post acquisition profit, which is 86,000, is automatically reduced, and the amount allocated to parent and NCI is also dealt with through the unrealized profit. The unrealized profit is automatically treated. The parent's earnings reduces, the subsidiaries, the NCI's earnings reduces. In the absence of it, what happens? If this is not treated, the post acquisition profits are considered to be 86,000, and the parent's earnings are inflated by unrealized profit 68,800, and NCI should also get a share. The moment we pass this entry, what is the entry we pass at this point? Inventories account credit, we need to reduce the inventories, and this adjustment will be on the face of the balance sheet, that is 9,000 on the face of balance sheet, because inventories are added on the face of the balance sheet. P plus S, parents inventory plus subsidiaries inventory, we are adding it on the face of the balance sheet. But since subsidiaries sold this, so NCI should also get a share. So non-controlling interest is being debited. Non-controlling interest is being debited with an amount of 17,200, 15,940, 17,200 minus 15,940, 1,260, and 68,800, 68,800 minus 63760 is being debited as group retained earnings. So when I say debiting this is indirectly means that the working note number 5 is reduced by this amount, is the reason it reduced from 63760, and the non-controlling interest is reduced by this amount 1260, so automatically NCI is reduced by 15,940. So the profit which will be added to working note number 5 and working note number 4 is already adjusted with unrealized profit. We do not need to make any further adjustment. If subsidiary sells to parent, the adjustment will be in the books of subsidiary. But if parent sells to subsidiary, if parent sells to subsidiary, the adjustment will be in the books of parent. The adjustment will be in the books of parent. Goods worth rupees 150,000 were sold at a markup of 30%, half of the goods remain in inventory. If they were sold at a markup of 150, that means 1,50,000 is equal to 30% of 1,50,000. The selling price was actually 150 plus 45,000. If half of the goods remain in inventory, 30% of it, selling price of it, $97,500. In other words, divided by 2. Half of the goods remain in inventory. So how much is unrealized profit? Unrealized profit is equal to 22,500. How to treat it? If parent sells to subsidiary, how to treat this? Unrealized profit on sale of goods to parent minus 22,500 minus 22,500 when parent sells to subsidiary. So the standard gives a choice. One, reduce the inventories and group retained earnings on the face of balance sheet whether parent sells to subsidiary or subsidiary sells to parent. When you do this, direction of sale is irrelevant. Because the only entry you are passing is group retained earnings debit credit inventories account. Now this adjustment is for someone who is not very emotional, because they can ignore that inventories are not assigned any deduction of unrealized profit. Now when we do this according to this method, when direction of sale is irrelevant, whether parent selling to subsidiary, subsidiary selling to parent, if we get to know that the inventories, contain unrealized profit, because we have simply added inventories of parent plus subsidiary, and whether parent sold to subsidiary or subsidiary sold to parent, if the goods remain in inventory, the inventories contain that unrealized profit, it is inflated. So on the debit side, we simply credit the inventories by that unrealized profit amount, and on the other side we directly charge it to, without bothering ourselves much, we directly charge it to group retained earnings. Unrealized profit directly charged to group retained earnings. Now the impact of this is that NCI doesn't get a share of the reduction of unrealized profit. So someone who wishes it to be very fair and is emotional, I always recommend them to go for the second choice. The second choice is that when inventories contain unrealized profit on addition, If parent sold to subsidiary, then make the adjustment in workings and deduct unrealized profit from working note number 5, group retained earnings. If subsidiary sells to parent, when parent sold to subsidiary, make the adjustment in workings and deduct profit from working note number 5, like we did here. Working note number 5, unrealized profit on sale of goods to subsidiary. When parent sells goods to subsidiary, we need to eliminate it from working note number 5. When parent sells to subsidiary, the adjustment will be in the books of parent. Before taking the balance to the balance sheet, you make the adjustments in the working notes. That's in the working notes. The total balance only goes directly to the balance sheet. In the balance sheet, we present only one single line item as group retained earnings. We do all the adjustments in the working notes. This is another way of doing it. If subsidiary sells to parent, then you can make the adjustment. If subsidiary sells to parent, make the adjustment in working note number 2. That is, working note number 2 is net assets of subsidiary on date of balance sheet deduct the unrealized profit from subsidiaries earnings. This results in reducing the amount to be added as post acquisition profit of subsidiary and share of profit of NCI. And automatically this entry gets passed. Automatically we are successful in passing this entry. Inventories in both the cases will be adjusted on the face of the balance sheet. Inventories in both the cases will be adjusted on the face of the balance sheet. So inventories anyway are getting added, parent plus subsidiaries inventories. We need to remove the unrealized profit from the inventories. This entry will be credited whether whosoever is selling whom. The inventories are inflated, whether parents or subsidiaries, they both are added together on consolidation. What we need to treat is who is earning that profit. If parent is selling to subsidiary, the profit is in parent's books, so remove from working note number 5. If subsidiary is selling to parent, the profit is in the subsidiary's books, remove from working note number 2. Though there is a choice in 1 and 2, but my recommendation is 2. That is, subsidiary selling to parent, make the adjustment in working note number 5. If If subsidiary is selling to parent, make the adjustment in working note number 2, working note number 2, and if parent selling to subsidiary, make the adjustment in working note number 5. So this will be more fairer, better, and we'll not be able to miss it out as well, and we'll be able to treat it immediately while we are calculating. Otherwise, when we are consolidating the balance sheet, we may miss out on consolidation that we have to treat or make this adjustment as well. This is how we deal with intragroup transaction in the balance sheet, in the income statement. How to deal with intragroup transaction for investment in associate. How to deal with intragroup transaction for an investment in associate. Now, associates are parties with significant influence wherein we are able to influence the financial and operating policy decisions, and we present in a single line investment in associate is presented in a single line in the balance sheet. Cost of investment plus share of profit from associate or joint venture. Since the accounting is same, I'm writing both. Since the accounting for associates and joint ventures is same, less impairment if any, less unrealized profit on sale of goods. The same is presented in the income statement. This is the balance sheet situation. The balance sheet we presented in a single line, one single amount. In the income statement, it is presented in a single line. In the income statement, it is presented in a single line. Share of profit from associate or joint venture. Share of profit from associate or joint venture. So suppose if an associate sells goods worth rupee 10,000 for a price of 15,000, for a price of say 18,000, and the investment in associate is 25%. So in case of subsidiary, we eliminate unrealized profit in full, but in case of associate or JV, unrealized profit is eliminated to the extent of share in associate or JV. Unrealized profit is eliminated to the extent of shares. So how much is unrealized profit in this scenario? And if I believe that all the goods remain in inventory, so 8,000 is the profit, out of which 25% to the extent of share, that is 2,000 is unrealized profit. So where will make the adjustments? One will make the adjustment here in investment in associate 2,000, and second adjustment will be in working note number 5, group retained earnings. Second adjustment will be in working note number 5, group retained earnings. Unrealized profit on sale of goods by associate. So if you look at associate accounting, this is the debit balance in the balance sheet. We present it in a single line. We present the investment in associate as a debit balance in the balance sheet, and the credit balance on the consolidated financial statement is retained earnings. So if you have to remove unrealized profit, on one side, on the debit side, we are removing it from the investment in associate as a single line item. On the debit side, we are removing it as an associate single line item, and on the credit balance side, we are removing it from the group retained earnings. We are removing this unrealized profit from the group retained earnings. So when we are preparing these workings, we may give this working in note number 6 or 7. This may be given note number 6, depending on when it appears, 6, 7, you can decide it on your own. So whenever there is an unrealized profit on sale of goods by an associate to a parent or parent to subsidiary, parent to associate, so unrealized profit is eliminated to the extent of share, and where it is parked, investment in associate will be having that profit because that is inflated by that unrealized profit. On the other side, share of profit, on the other side, share of profit from associate is inflated. So whatever is the share of profit from associate, this amount is also inflated. Like in the cost of investment was say 90,000 and share of profit from associate was say 25,000, and if there is any unrealized profit minus 2,000, the net balance to be presented in the balance sheet would have been 90,000 plus 25,000 and minus 2,000. In the absence of this, share of profit in associate would have been included at 115,000, because that's the share of profit from associate which will be included as part of working note number 5. We include as part of working note number 5 group retained earnings. Included as part of working note number 5 group retained earnings profit of 25,000. Sorry, it is 25,000. It is 25. Share of profit from associate is 25,000. So when we treat unrealized profit, we need to treat minus 2,000 from here, as well as it will be treated minus 2,000 here. So when we pass this entry, investment in associate credit and group retained earnings debit, these two entries automatically get done. So when we pass this entry to treat unrealized profit, investment in associate credit 2,000, debit group retained earnings, will be successful in making the adjustment of unrealized profit for sale of goods by an associate to subsidiary, or vice versa, because even if parent sells to associate, that will be in the profits of group retained earnings, and if parent sells to associate, that profit will be in the group retained earnings, and that inventory will be in this single line presented. That inventory will be in this single line presented investment in associate. Though we are presenting it in a single line, but that inventory is within this investment in associate plus share of profit in this equity accounting. That inventory exists. So that unrealized profit we remove from both sides. Whosoever is selling, direction of sale is irrelevant in this case. Whosoever sells, whether parent sells to associate or associate sells to parent, we have to eliminate it from the group retained earnings, and we need to eliminate it from the investment in associate. So this is how we deal with intra-group transactions between an associate, JV, subsidiary. So if I sum up, unrealized profit on sale of goods between parent and subsidiary are eliminated in full. Will not apply any percentage to it. Unrealized profit on sale of goods between parent and associate, or JV, joint venture, are eliminated to the extent of share in associate or JV. In case of a subsidiary, on consolidation, intra group transactions are eliminated in full, and we need to remember the principle. Asset of one entity and liability of another gets cancelled on consolidation. So this is all for the day. Thanks for your valuable time. I need to inform you that there is a offer going on, that if you use the code ACC Amit on Unacademy, you get an instant discount of around 80% for subscribing for 1 month. And there is a offer which is reduced subscription price, and you can get the CA final course for only 999 using the code ACC Amit. To know more about me, you can have a look at my profile on LinkedIn and Unacademy. So this is all for the day. See you again tomorrow at the same time. We'll be discussing about the deferred taxes. Thank you.